Welcome to the TAC Index AI podcast. Here, we blend TAC IP data reports, charts, well, basically everything logistics, with a real focus on air cargo. For you, navigating these complex global supply chains, our mission today is really to cut through the noise. We're going to dive deep into the latest TAC index data. We'll connect those air cargo trends to the wider logistics picture, the macro market, and key things like jet fuel and capacity. So get ready. We'll try to uncover what's actually driving these movements and what it might mean for your operations. So let's kick off with the latest from the TAC index then. Globally, air freight rates did ease slightly last week. The Baltic air freight index, the BI0, it dipped 1.7% week over week, which leaves it down, about 8.2% over the last 12 months, sort of fits that quieter summer low season idea. But is that the whole story?
Well, it rarely is it? What's really counterintuitive here, I think, for you, is that even with this overall easing, we're still hearing reports of persistent high demand, specifically in key sectors, garments, pharma, electronics, semiconductors, really crucial stuff.
Right.
And even with capacity constraints causing delays in, well, certain markets anyway, the overall rates were still flat, maybe even down a bit. It really suggests that the broader global capacity, maybe from new routes or carriers not being fully utilized, is sort of subtly absorbing these spikes. It creates this fragile calm, I guess you'd call it.
Fragile calm. I like that.
Yeah, and it could easily break when we hit peak season.
That's a really interesting distinction. So if the overall trend is easing, but you've got these specific hotspots, does that mean the whole low season idea is maybe a bit too simple? Let's zoom in on those details you mentioned. Rates out of China to Europe, they were flat.
Flat, yeah, and a little lower to the U.S.
Okay, but India was different.
Completely different picture there. From India, we actually saw rates tick up week over week to the U.S., to Germany, Europe more broadly.
Wow, okay.
Still way down compared to last year, mind you, but definitely a weekly increase.
Right, and then London Heathrow, BAR 40.
Yeah, Heathrow gave back quite a chunk of its recent gains. It fell 6.1% week over week, mostly because of big drops on the transatlantic routes. But interestingly, it's still up year over year, about 4.5%.
So it really is a patchwork, isn't it? Not a uniform trend at all.
Exactly. It's definitely a patchwork. And when we connect this to the bigger picture, thinking about your long-term planning, tariffs are really playing a huge role now, reshaping logistics, trade flows. Just look at August 27th. U.S. tariffs on Indian goods doubled, up to 50%.
50%. And that's tied to India buying Russian oil.
Right. That's the connection being made, yes.
Yep.
And it's a massive blow for major Indian exporters. Think apparel, furniture, diamonds, big sectors.
You mentioned earlier that American companies often bear the brunt of these tariff costs initially, but isn't part of the idea the policy goal to protect domestic industries, maybe offset some costs by boosting local production? Are we seeing any sign of that in the logistics data yet, or is it just, a cost pass to consumers?
That's the million-dollar question, isn't it? The long-term goal might be boosting domestic production, yes. But what our sources are showing now, in the immediate term, is that American companies are indeed shouldering most of that initial cost, which, like you said, often means higher prices for you, the consumer, down the line.
Right.
And this uncertainty, it's not just India. China's facing 30%. Mexico might go from 25% to 30%. It's definitely causing supply chain reshuffles.
So much uncertainty.
Exactly. And it's happening even while we see this other big macro force, the AI-driven bull market. Nvidia, semiconductors, electronics.
Which are sectors you said still have high air cargo demand?
Precisely. So it's this weird mix. Tariffs are adding friction, but underlying tech growth is keeping some key cargo lanes incredibly busy.
Okay, I'm trying to connect all these dots. We've got uneven demand, these volatile tariffs, and now rising jet fuel costs on top of it all. That sounds like a nightmare for planning. Oil prices have been edging up, right? Brent crude, WTI, both saw increases?
They did. Brent up 1.2% to around $68.05. WTI up 1.4% to about $64.15.
And part of that's linked to lower U.S. inventories and pre-Labor Day travel demand.
That's part of it, yeah. Strong gasoline demand. But the ripple effect here is, well, it's profound for logistics. Think about the uncertainty from the India tariffs, ongoing geopolitical tensions, attacks on energy infrastructure. It all pushes oil prices up. And for air cargo, rising jet fuel is it's a constant headache, directly hits operating expenses, squeezes margins. One report described trying to forecast profitability like trying to hit a moving target blindfolded.
I can believe that.
And then if interest rates do eventually come down, as some hope, that could boost the economy, boost oil demand even more, further complicating things for your supply chain planning.
Wow. So for you listening, whether it's these subtle, almost deceptive shifts in overall air freight rates, or the really big impact of tariffs reshaping trade and costs, or just the rising price of oil driven by this complex mix of economics and geopolitics, it seems crystal clear that everything is deeply interconnected.
It absolutely is. The global logistics landscape is just this delicate, constantly shifting balance. So the next time you're analyzing your global supply chain, you really have to consider more than just the destination. Think about that whole intricate web, trade policies, energy markets, even tech trends, because they all ultimately decide how quickly and how efficiently goods actually get to you.
Okay, so a final provocative thought for you to chew on. Given all these dynamics, we've talked about the nuanced rates, the tariff battles, rising energy costs, what kind of innovative new strategies might your company use? How can you build resilience and maybe even gain an edge navigating these interconnected challenges, especially as we head into what looks like a pretty unpredictable peak season?